Good afternoon, everybody. Welcome back to the weekly market review for the week ending May 3rd, 2024. April is over, and April was a down month in the equity markets, and May starting off really strong. S&P is up 1.73% in the first 3 days of May. NASDAQ up 2.24% in May so far. Russell up over 3%, Dow up over 2%. The question that we are going to be dealing with today is, did we just get the all clear in asset markets, across risk assets, across the markets for upside? And we'll dive into all of that in just a second. But I want to first remind you to hit the like button and subscribe to the channel. And then you can also find me on Twitter at Mr. J. Thomason, or subscribe to my free weekly newsletter at befinanciallyfree.substack.com. And once again, I just want to point out that one of the things that I do every week in my newsletter, particularly in the second section, which is the summary and outlook section, and I summarize essentially what follows in the rest of the newsletter through all of the data. And I specifically talk here in the middle of that section about the likely direction for risk assets over the next week. And last week is the first time I put essentially that it's not just that it's uncertain, but that there's balanced risks to the upside and to the downside. And this is, I would say maybe arguably the first week in 2024 where coming into the week, I did not have any clear direction on where the markets could possibly go. And what's really interesting then is if you, again, looking at the markets on the week, S&P ended up on the futures ended up 0.45%. If I look at SPY, which is the ETF, it was 0.6%. But obviously, you can see that we were down pretty significantly throughout the week. I mean, just look at the chop, right? This is Monday. We went down, and then we went right back up. And it's funny because the things that, frankly, the things that I thought might be catalysts for downside ended up not being so. Not because they, mostly because the assumption that I had about the market was wrong. So, I mean, for example, if we go to a 10-minute chart and try to look at prices this week, so let's go. Let's see. This is Monday. All right. So, we had a couple of different things happen this week. The big one was the FOMC, and what's really funny is the FOMC day had this little spike, and where we basically popped on the Powell presser, and then essentially as soon as the presser ended, we sold off into the rest of the trading day. And then we had, and that was also, by the way, on, I believe it was earlier this week, we had the various in pieces of information. We had the Treasury quarterly refunding announcement on Monday and on Wednesday, which both were more hawkish, arguably, than maybe it was expected. We had employment cost index, and we had productivity, both of which came in. The data was actually not good, so the employment cost index came in higher than it was supposed to, and the productivity came in less than it was supposed to. And then we had ISM services where the PMI was down, obviously in contraction. After, I think it was last month, I pull out my data charts for a second. Let me see if I can get to this really quick. So if you go to the ISM manufacturing, which is, the PMI is on the left side of this chart, we had a 50.3 reading. I think that was the first time in like 18 months that the ISM manufacturing PMI was above 50. Well, that went back down below 49, but then when you go to prices, which is over here, you can, if you see my mouse on the right side, prices paid jumped considerably, right? And then so a lot of inflationary data, even as growth was declining, and that's kind of been the name of the game. So whether it be productivity, whether it be the ECI, ISM manufacturing this morning, the ISM services data, the services PMI came under. This is actually, and I don't have it. I don't have the time series chart to be able to show you this, but 49.4 was the ISM services PMI, and that's the lowest number. That was even lower than what we hit during, I believe it was in the middle of 2022. It was the lowest. It's even lower than that. So, and then in the same way, prices again took a huge jump versus last time. And then when you look at the non-farm payrolls report, so let me get this up. Non-farm payrolls data. So these are some of the things that I look at. So you've got the left set of bars, which is the non-farm payrolls, which is the establishment survey, and then in the middle of the set of bars of this left panel is the from the household survey employment level, and you can see in both cases a decline, significant decline from the previous level, but then also we are well below, we're below trend. And then I do an average payrolls. This is just, I don't usually report on this in my newsletter, but I do an average payrolls because I try to smooth out what's in the establishment survey versus what's in the household survey. And that's also below trend, below its pre-COVID trend, and well below last month's reading. And then we had, interestingly, we had earnings decline. So that's maybe doesn't fit necessarily the I mean, this is like, by the way, this is annualized rate of change data. So at least on the right side panel. So we didn't see as far as average weekly hours or earnings, I should say, average hourly earnings, pardon me. We didn't see inflationary data in that sense, but definitely growth to the downside. And so people are throwing out the stagflation terminology here. And so I think that that's kind of interesting. And all that is to say that, like, all the data this week suggested growth declining, inflation rising, or maybe not rising, but at least sticky. And despite all of that, arguably the worst case scenario as far as the economic data is concerned, markets are up this week. And so I think my gut reaction is that, I mean, you guys know, if you've been watching this channel, I have a bias. My bias has been that we were going to have this correction, and I think that the correction started in the S&P at the beginning of April. And I personally don't think the correction is over. In fact, if I just show you that, if I just pull up the price fractal from the the summer correction from last year, and I have it aligned slightly to account for the length of time that the declines have taken so far, and just like price depth and stuff, and I mean, we're kind of on time, as far as like this bounce is concerned. We're not quite at the level yet that, in my opinion, shows that we're out of the woods as far as the this decline is concerned. I would want to see us get over 5250, and we'll start by getting over 5200 and get over it with gusto, and stay above it without rolling over. But this is, by the way, why shorting is really hard, and why corrections and bear markets, even if price goes down over time, why they're hard. Because if you got this right, I mean, the earliest indication, the earliest indication that something was wrong here probably would have been Thursday the 4th of April, or maybe Wednesday the 10th of April, back when we got that CPI report. And if you took the short, I mean, if you're doing what normal people do, what good risk managers do, and you're taking the trades after they hit, after they close, then depending on where you caught this, you have, if you took the trade at the close, then you gained, a couple percentage points to the downside. But if you're still holding it, then you're not super far away from, break even. And so, corrections, pullbacks, bear markets, they're hard. So, you have to be really good and really precise when you're trying to take shorts. And, so in any case, so what was I saying? Oh, so my bias is down, but given that price action behaved the way that it did this week, despite all of the inflationary news, I think typically would normally have me thinking that there is that this is going to continue to the upside into at least into next week, and maybe that we're even starting the next leg up. And I think, like, you can hear the hesitation in my voice. I'm not so sure. I have to be careful because I do have this bias that I think a correction is still commencing, still happening, and I can't let that get in the way of what the tape is telling me. What I will say is, I think the thing that throws this off this week is I think market participants largely are just extremely excited about first the Fed. Despite all of this inflation, they basically took a potential rate hike off the table, because a lot of people were talking about the fear of a rate hike, of the Fed going the other direction as far as the rates were concerned and going back up and hiking. They took that off the table. They announced balance sheet reduction, like tapering that. So QT is going to be less than it has been by a pretty significant margin. And that was a surprise. The amount that they were tapering it by was a surprise to a favorable surprise. And Powell pretty much said, like, you could tell they have a cutting bias. They want to cut rates. They want to lower rates. They want to ease. And they don't seem fazed at all by the adverse economic data that has come out as of late. And I think, just given how dovish that they were, I think that's part of the reason market participants are so excited. Sorry about you saw my screensaver for a second there. But even today, I mean, just think about this. At the first sight of weakness, this is the 10-minute chart again. The first sign of weakness, I mean, as soon as that payrolls was released and it was under, the unemployment rate was higher by 0.1 by 10 basis points. Payrolls came in less than what was expected, 175,000. And I mean, this is where the markets are at right now. It's kind of funny because the market right now wants fewer people to have jobs. It wants more people to be unemployed, and they get excited about that because then that means the prospect of easing is coming in. And we're in that stage where that is gonna, like, any sniff of such a thing. You can see here in this 10-minute time frame, the S&P moved up. What was that? S&P moved up 42 points. If I put it on the 1-minute chart and look at that, most of that gain was in 1 minute. 38.5 points in 1 minute following the payrolls release. And even though the ISM data came out and it was showing stagflation, markets came off, and it looked like they were going to give back this gain, but then they regained it all. So again, like, right now, I think a large degree of the excitement in markets has a lot to do with the Fed position. I mean, I think everybody understands in an election year, you obviously have the Treasury, despite the QRA being more hawkish than was expected. You have a Treasury Secretary who is going to want to make sure that her boss gets reelected. And you have a Fed who has an easing bias to them. They want to ease. They want to loosen, financial conditions. They're showing some concern about growth being a greater priority, even though they're paying lip service to inflation. A couple other things I want to point out. The VIX got crushed, right? So if you just look at it on the weekly chart, it just got crushed. Down almost 20% last week, down about 10% this week. And it has been getting crushed even before the FOMC. Even on FOMC day, the highest that we were up at was 1626, something like that. And then we just have accelerated the selling of the VIX since then. So the VIX being sold, systematically speaking, structurally speaking, is positive for equities. That has definitely helped. The dollar took a break this week. You can see if you look on the weekly chart, we lost about almost 1% on the dollar this week. However, I think what's interesting is on this day, I mean, the dollar still ended down, but despite the non-farm payrolls report, the dollar closed off of its lows, well off of its lows. And I think that that's telling of dollar strength. If you actually look at it on the tide indicator, this is a pretty beautiful, touch, right? You get the price action coming down, piercing the tide line, but then closing well above it. It's entirely possible this thing could still come down further. One of the big things about that happened to the dollar this week, other than the FOMC, is we had yen intervention, and that obviously put a little bit of pressure on the dollar. And despite all of that, the dollar was down on the week, but it could have been down a lot more. The big story that was being talked about was the drop in yields. So yields on the 10-year dropped 15.5 basis points. So now we're trading just above 4.5%. Again, I think, my bias, and this is me going back to trying to be systematic and following the trend in this particular case, but the tide is still bullish here, and as long as the tide is bullish, the trend is more likely to remain up. And there's all sorts of, I feel like I've talked about this a lot of different times, there's all sorts of opportunities to show how in the last couple of years since 2021, how many times everyone talked about, oh, yields have topped, they're going to roll over, yields have topped, they're going to roll over, and how many times did it not? Every time people thought it was going to roll over and just kept going up. And there's all sorts of examples, even just from the run last year, situations where everyone believed that the yields they were inevitably going to come down more and more. Like think about SVB, the drop in yields there with the liquidity injections and all that kind of stuff. And anyway, point being, yields are still bullish tide, bullish trend, but they did come off, so that has contributed quite a bit to the boost in asset markets. Bitcoin's still trading. Obviously, this is a 24/7 asset. Bitcoin's having a huge day. What I want to say here is, Bitcoin is currently trading $300 above the level where I sold a trading position that I had been riding for quite a bit of this run, and it's more than 60 days later, and we're barely above those levels. And I keep talking about this on Twitter, and I've talked about this in my Substack. There were a lot of people back here in mid to late March talking about how, oh, the bottom's behind us, buy it now. And everyone is jumping for joy about this price action today. People were talking about inflows today into the ETFs, and yeah, great. But then at the same time, don't celebrate too much until this actually clears and repairs some of its technical damage. In fact, you can see I've got the above trend line there. I can already see a trend line right here. Oh, sorry, I gotta fix that a little bit. There we go. So you can see clear market structure there. So that's going to be the place to watch for a breakout. And until we get a breakout and a continuation up, I mean, this thing could consolidate still sideways and until June or July before making new highs. And that's the thing. Like, I obviously am rooting for Bitcoin. I have a long-term position, and it would be great for me if Bitcoin just went to the moon right now. But I think people just need to simmer down a little bit, and I think I said maybe I said this last week, but I think Bitcoin needs to get to the point where people think the halving or the ETFs are already priced in, and I think probably the halving, because the halving is the most recent catalyst. But my guess is people have to believe that the halving is priced in before we can actually take off. People have to lose interest, and they haven't yet. And I know that they haven't yet because all the influencers are still out there, saying all the things that they say. In any case, a couple other things. So like I said, I've been kind of laying out why asset prices have gone up, or why stocks particularly have gone up, what has contributed to that. What I think is interesting is that on price action today on gold was flat, generally speaking. Crude oil down, it's been going down. Silver down, despite the very, very dovish growth down dynamics of the news releases today. To me, that kind of stuff should have been bullish, but the problem is that these trades have been so crowded that they're having a hard time taking off. The last thing I wanted to look at briefly is breadth. For all the price action, all the discussion and stuff today, and just given the price action this week, breadth is not confirming. When I think of breadth, let me turn the tide off really quick. When I think of breadth, I think of how many stocks are moving up and participating, and in this case, above their 50-day moving averages, because that shows that the momentum across the stock market is more up than it is down. And that level, that really appropriate level, is the 50 level. So you can look at it at the 50-day moving average or at the 200-day moving average. And in terms of the 200-day moving average, that's a longer term indicator. So this can stay where it is. But so like, for example, the correction last summer started at the end of July, and we actually got into late August and bounced up, and basically it was late September before this got all the way below its 50 level. So on a near-term basis, the best one to look at is the 50-day breadth. And what I usually like to see here is, so if I go to the S&P here, what do you see? What you see is the price action bounces from this low on the 19th of April, sells down, and then on the close today, we made a higher closing high. So what you want to see is you want to see other indicators confirm that. In this case, what you would have wanted to see is the breadth also try to at least make something close, but it actually didn't. So that tells me that there's divergences present in the price action, and that gives me caution. I'm not saying that prices are going to go down next week. I have to obviously do all my research this weekend, but I do want to say that this is that gives me cause for concern. Other things that give me cause for concern, let me go to the asset allocation survey. This is just one thing you could look at. It obviously doesn't mean assets have to go down now or that they have to go down a certain amount, but we continue to see the allocation to stocks go up and the allocation to cash and bonds go down, which is the kind of behavior that you tend to see ahead of market peaks or ahead of corrections. And so I think that that's important to point out. That's something that is somewhat concerning to me that I wanted to point out. On another note, let me see. Good news as far as well, actually, it's interesting. Sentiment got more bullish this week after having taken a dip last week. So that's kind of interesting. To me, it makes sense after the FOMC. It would make sense that sentiment would read a little bit higher over this last week. It's come down from extreme levels, so there's not a huge amount of concern there. But I do want to point out that that it is reflective of the price action this week. In any case, it's just interesting because, again, like I said, my gut tells me that prices are probably going to go up given that the equity market was strong despite all of the bad news. However, there still is some technical repair that needs to happen. There's still, we've had a lot of catalysts this week that I forgot. I didn't even talk about earnings this week. That also could have contributed to a lot of the things that happened this week. Which is actually, there's a lot of stuff ridiculous about that. I mean, I won't go into it, but if you saw any of the earnings reports, the stories from like Apple, some of the stuff going on there, it's laughable, the kinds of things that can move markets and get investors excited about certain things. In any case, it's not our job to invest based on what we think should happen. It's our job to invest based on what is actually happening. And what's happened is the market's closed up strong despite all of this bad news, was definitely helped by the Fed, and it would make sense for asset prices to continue up into next week. However, there are indicators that suggest, this is the other one, high beta to low beta ratio. There are indicators that suggest that this price action might not actually hold, and that we might actually be in the process of bouncing before rolling over. I was just going to say it is a little concerning here. You want to see the high beta to low beta ratio on the price action that we've had this week. You want to see that going up, because if you look over time, especially since the 2022 lows, when high beta leads, that tends to mean stock market's going up. The last time that this wasn't the case, the last time that there was declines over a period of time, was back during the summer correction, and so I think we have to be concerned that if this thing is rolling over. Obviously, a good way to look at that is the tide indicator, and we are still bullish tide, but now the trend is sideways, and we failed to stay above the tide line on this indicator this week. So there are things that are still cause for concern, but I think if I had to put money on it now, if I had to answer you now, I would say that the most likely trajectory is to the upside next week, but time will definitely tell. And with that, we'll stop for the week. Thanks for watching. Don't forget to like and subscribe. I'll see you guys next time.